Ladies and gentlemen, welcome to episode number 11 with Investing with the Boys. It's a great thing it's episode number 11 because topic is Stranger Things. Stranger Things in a market, 11 Stranger Things for you listeners out there on that show. Yeah, I mean, things are just wishy-washy. If you have a weak stomach, this is not the market for you. You think you got the green light, and now we're in defense mode. So, Logic, I'm going to pass it off to you. How are you maneuvering this market? Because I think just a couple of days ago we were all bulled up, and now things are a little different.
Look, I think we made a pretty funny joke last time we talked about who we are as people, as traders. Like Sam is the 200-day moving average, you're like the 50-day or something, and I'm like the 9 EMA on the 5-minute chart. That's accurate. I would say that's definitely true. I came into today very, very long, like way too long, like 110% long, and I didn't want to see this price action. It's not like the end of the world kind of price action, but it's the kind of price action that makes me like, okay, you know what? Maybe this is going to continue with the volatility, the back and forths. We just got news. It's Wednesday, March 26th. We got news that there's going to be auto tariffs, and they're pretty extensive. Talking about pharma tariffs. I mean, that's going to cause big ripples in the employment in those sectors. And yeah, I mean, that could make unemployment jump on its own. And so there's a lot of implications there. I think we started getting a lot of sentiment around, Trump's going to walk back the tariffs. And we're getting this narrative that, maybe he's a little bit too much of boy cried wolf. And so I think, he's trying not to back down from that, because if he does, then he's kind of in a tight spot where he's going to lose credibility. And so I think it's a wait and see kind of market right now. And so, today I reduced my long exposure by like 30%. So I went to like 80% long, which I think is fair and a little bit more defensive. And on top of that, I actually ended up taking a 20% short exposure. So I'm net long 60% now, which is a lot less. And again, these things change day to day. I adjust based on price action. Like, we'll see, right? Like, was this a one-time thing? Is this? I'm like you just saw. I just swung from 110% long exposure to 60% net long exposure. So like, I can switch things up. I'm much more of like active trading when we're in this kind of environment. Everyone loves to be a buy and hold investor, but when a real bear market comes, then you're a bag holder. And I'm trying my best not to be one. And I want to give a little bit of background to the people listening. Is like, I manage money for myself and my wife. That is the only two people that need to be happy at the end of this. So I'm not really paying attention to too much.
I think you left out two individuals who are present with you right now, and I'll let you redo that statement.
No. So the way I'm managing my money is like I'm very much prioritizing positive returns and like avoiding drawdowns as much as possible. So I'm hyper paranoid. And like I've been talking about ad tech a lot, and I went a lot more bullish ad tech because, if this was the bottom and we ended up pricing in 40, 50, 60% downside in these names, but it was all sentiment driven. Maybe it was a short term pullback in spend on the marketing side because the tariffs, there's uncertainty. Then you could see a rip rally into the end of this year. We said that, ad tech could easily be, if we saw a rebound, it could be one of the best performing sectors given how much we just discounted. But if these, if these tariffs really do have teeth, then they're going to hurt. And so that's going to pull back a lot of these sectors' marketing budgets. I mean, if pharma, if auto industry is going to be hurt by this, then I'd imagine that they need to cut costs. And yeah, so
I think I want to talk more about those auto tariffs. I think that's something that just dropped 4 hours ago. I think that's a real thing that's going to last a long time. Have you guys looked into?
yeah,
I can give you my spiel on it if you
Yeah,
guys
go
haven't looked
ahead.
into it, but no, I
yeah,
think
go for it.
this. I think the high stakes poker game that Trump is playing with all the other tariffs. I think maybe the bark's louder than the bites. April 2nd might be not as bad as feared. I think this auto tariff is very real. I think
This is
it's going to
very big.
be multiple years, the next 4 years of his presidency. I think this is what a lot of Tesla shareholders were hoping on for the first buddy, Elon, to benefit on that relationship. And it's such a chess move when you think, well, before I get into like why it benefits Tesla, let's get into the bigger picture. A third of all the cars sold in the US are built outside of the country. This one move of raising the tariffs is going to upend so many pricing models, supply chains, long-standing businesses of nearly every single automaker in a business economics that isn't really that great with margins. All these automakers are going to be suffering. Some might file bankruptcy. Some might have to sell cars at loss. Tesla will not have to do that. most of the industry is going to scramble to respond. Tesla's already perfectly positioned, like whether it's by the design or sheer optimism, like the company is now poised to be the last man standing and just make the case for the full domestic production is like the key to agility. That AS reference, that auto as a service is going to become more of a reality. And I do think that, I'm trying to phrase this in a way, Tesla isn't what it was a couple years ago. There's no denying that. Like Elon's politics have affected a lot of demographics. I'm not immune to that. I'm a big time Tesla bull. I love Elon for what he is. Ignore politics. I purely view it as a show, but I know large demographics are not buying anything Elon touches. So I do think if EV adoption is slowing across the board as affordability will remain a key challenge. Like I think Tesla may no longer want to sell individual cars to millions of people. I think that's maybe the old playbook. I think the new playbook might be replacing car ownership entirely and just creating this auto as a service, like the AS reference I was saying, or transportation as a service. So I think that's why he was like not caring at all about his delivery misses, his delivery sales. I think he probably knew this was going to eventually happen. That's going to kill off all his competitors. He's going to be a last man standing. And it doesn't matter how much consumers hate him. Convenience and pricing is at the utmost consciousness for a lot of consumers. They're not going to like hate Elon so much that they're going to pay more. They're going to wait longer to get from point A to point B. Like, I just don't see that kind of hate out there. And Elon's going to win at the end. So, like, I really do believe this is going to be a massive tailwind for Tesla that isn't going to be short-winded. It's going to be elongated. And I think this is also the pre-read of clear regulation approvals for the robotaxi. I think the robotaxi becomes much more of a reality due to the need for consumers to get from point A to point B when our prices will only go up and up and up in the next couple of years. I don't know. Sam, Logical, do you guys disagree with me? Because I know I'm the Tesla bull among this group.
No, I think Tesla's going to do great in the long run. I just think, for me, Tesla has always been a massive momentum trade for me. And not because of the fact that I don't think the company's going to do well in the long term, but because of the fact that the company is completely detached from its existing financials and fundamentals and mostly driven on news and speculation. I mean, don't get me wrong. Like, I'm sure if you buy Tesla today in 5-10 years, you'll do just fine. But a lot of it is in the auto industry as far as financials goes. There is no, well, I don't know if there's actually no revenue, but as far as I know, there's no revenue being generated in something that could be material contribution to its actual revenue from auto sales, like robotics. You know, I don't think Optimus is bringing any revenue.
They have the energy storage business.
Yeah, but that's not, that is ramping up, but that's not like,
small.
Yeah, it is a small contribution revenue. I mean, the idea here is, because I actually saw a chart. FinChat posted a chart today saying that that BYD actually earns more money than, or takes in more sales than Tesla does now, which is ironic because I looked at that chart and it was like BYD just kind of slowly linear way up. Tesla just basically been stagnant, which is reflective in terms of the delivery numbers. But don't think that this tariff does not impact Tesla, because it certainly does. Because I think about a third or a quarter of their auto parts are actually imported, but the rest of them is actually contributed from US and Canada. So I don't know how much of that is Canada. And I'm going by this from some article that I saw here that was posted online where they disclose these imports. But the thing is, hold on, let me finish. The thing is that even if it won't impact Tesla as much, if the stock goes up, it's not because of the fact that they're going to do better in sales. It's the fact that investors are perceiving that Tesla's going to come out on top. So again, with the momentum and speculation trade that's going to take place in this. But I mean, it's very hard to believe that if the economy does go into a massive slowdown and the market pulls back quite a good amount on that Tesla is going to be flat. It might, well, but
go ahead. Can I ask you a question about this? So I don't think people are going to buy Tesla cars. That's what I'm trying to get at. I think they're going to go through the Cybercab taxi, and it's going to be so cheap via Autonomy eventually that's going to be the status quo. Like, I don't think people are going to want to own cars, a depreciating asset anymore, like cars. Like, I think that trend is going to potentially fade. If Autonomy scales, the way Elon says it's going to scale.
Depends on your timeline.
I don't know.
Like what you can't.
That's the thing. Depends on the timeline, but also like, do you think Ford and GM and these like automakers are going to sell their cars at losses? No, like, they're going to raise the prices.
There are other full self-driving licenses, obviously not using that trademark, but there's other ones besides Tesla. Nebius has an entire line of autonomous driving, and
that's
licensed
it's
with Uber,
it's so
right?
specific though in which cities that they can use it though.
I think
that's
they're doing
issue.
it in like they're doing test trials in like certain cities in the U.S. with Uber, and even Lyft is doing that too. But what I'm saying is that this isn't something that it might cause it's going to cause volatility in the stock for sure. Like it's going to go up, down with news, whatever, and just how it always does. Nothing's going to change. But all I'm saying is that if the economy does go into recession, it's funny because we would never be talking about a recession like 3-4 months ago, right? This is becoming a topic now, which is kind of
25% chance now of a recession. That's why it's a real thing now.
Well, we came into the year with like a very low percentage. That's the thing. Like it's the change that happened as far as the percentage or the chance of recession that is really affecting the market. But along with that, also there's a bunch of downgrades that these analyst firms are putting on the stock market. Like they're decreasing their price targets and stuff. This is a cascading effect of either a confirmation bias or either a fulfillment prophecy self-fulfillment prophecy that like if people prepare for a recession, that in itself will cause a recession. So like that's what I'm saying. And when people do prepare, if consumer confidence goes down as far as consumer discretionary as well, I don't think Tesla will be protected. But as far as the tariffs go, it appears to me that Tesla might not be as highly impacted as the other manufacturers. But then again, GM is down like 5% after hours. So we'll see what happens.
And I think Tesla was also up 3%. After
it was,
hours.
but it's flat again.
Down.
It's flat again?
Yeah, it's
oh,
flat
wow.
again.
Interesting. I didn't see
I
it.
know, it's crazy, right?
I mean, it's a great argument. Like, do the tax of your competitors equal a tailwind for you if everyone else falls and you're just the last one standing? Like, I agree. Like, it's not the best. It's not the best combination.
It's
but
enough for speculators to come in and bid Tesla up.
Yeah.
Like that's the thing. Like,
especially with
you can't really. You're not going to see it in their sales anytime soon. You're not going to see the bottom line go up based on that anytime soon, and you're not going to see the bottom line on other companies go down anytime soon. But the speculation is going to. The price discovery is going to occur.
Why is that? If tariffs are going into effect April 2nd?
Well,
why
I
would
mean,
you not see it soon?
I'm not, but I'm saying that you're not going to see it as significant impact that'll put Tesla that much ahead as far as the earnings growth compared to other auto manufacturers. It's not going to like have material effects soon. That's something that will take time to cascade and play out, right? Because even though the costs go up, you know these accounts like they're not going to be like, let's just put all of our losses over here. Like they're going to make it so that way it just slowly dribbles down if it does continue to take into effect.
Well, I mean, it comes down to the outlook, though. And the outlook for these car manufacturers are going to be awful, and Tesla's is probably going to be incrementally positive because of this. So even if you don't see it this quarter, next quarter, you're going to see it in the outlook.
And you also know consumers read headlines. Consumers are going to probably like, oh, I'm just going to wait till the tariffs are going to be done, and then.
And every person if you are covering any of these car manufacturers right now, you're crunching your numbers at your desk all night, and you are trying to come up with what the new models are going to be. And also, like, you have to think, like, there's probably going to be a lot of reports in the next couple days coming out on Ford, GM, Magna International, BMW. I mean, we haven't even see what the move is on some of these other stocks that have, they trade on OTC, like BMW, for example. We don't know what that's going to look like tomorrow, but BMWs are already expensive. If they get more expensive, it's going to be really deterring their base. So, I mean, it definitely has a big impact. And just to quote a couple things, like General Motors, I mean, they posted, let me see. Let's say like they have like 6% net profit margins. That's actually pretty solid. But when you look at Magna International, that includes like Jeep and all sorts of things. Oh my God, my cat is crying. Do you hear him?
He does not like the
Bring
tariffs.
The
he is crying.
That cat was like long Tesla calls.
It's like, logical. You promised me a BMW. Now you're not going to get me a BMW.
The cat bought weekly Tesla calls at yesterday's close. Thought he was going to make him be a millionaire.
Look, Magna International had like 2% net profit margins last quarter. Ford has, 3 to 4%. Sorry, just go without me. I got to look at this cat. Go for it.
Someone tell that cat to short the market. Like that thing is just suffering, man. Anyways,
I mean, yeah, to go off of, I mean, listen, like, end of the day, there was so much FUD priced into Tesla stock in the past couple months. It needed some catalyst to buck that trend. And also, this might be another read-through of, like, if Trump's doing this 4-year auto tariffs like this, what else is he going to do? Like, it clearly showed, like, it's not FUD that he is first buddy. Like, this is real. We're seeing the first signs of it. What's next? What if Optimus becomes the go-to government robotics partnership? And now Optimus is going to have all this government funding, and that becomes accelerated for the robotics angle. Who knows on the energy storage business? Who knows for Starlink, for space infrastructure? It's like unprecedented times where you're seeing clear signs of broing down together on something that's going to affect so many citizens. Nobody's scared, like nobody's batting an eye. Like that's just how it's going to be.
I actually think that the more sure robotics play is Amazon. Like it's just when you think,
100%.
When you think about the company that's probably going to benefit the most really quickly in terms of robotics infrastructure, it's probably going to be Amazon because they're already doing it. And they're just literally adding onto the system, right? But like Tesla, it's like these robots. I mean, they're going to put it in their factory probably and everything. I think they already are, right? They're already having the robots do some mundane activities in their factories. Like, it'll definitely help. When you think of like at scale, like this is going to be, Amazon's going to definitely be a beneficiary of robotics for sure. Actually, that's something we never even talked about. We never really talked about robotics that much.
We haven't because it's so future looking, and there isn't a pure robotics company out there. I know
there's some.
There's one Symbiotic is like, I think Symbiotic is sketchy. Never passed my sniff tests. Customer concentration risk.
Walmart.
Amazon's quietly leading the logistics robotics.
Mercado
Tesla
Libre
is going to be leading. Yeah, Mercado Libre is going to help them a lot. Your NVIDIA, like CUDA, is going to become the virtual environment for the physical AI or robotics theme. So they're going to have a heavy exposure in that. And then Tesla, real world, they're solving the real world robotics. So those are the three names. Like, and they're somewhat safe. Like, again, like in this environment, the market's clearly wanting a next new leg lower. Like us briefly staying above the 200-day moving average, not even for 48 hours. Not even for 2 full days. That is such an alarming sign. It is so alarming.
Dude.
No?
No, I agree with you. Yesterday, the Qs went over the 200-day after hours. It's like you would think that, okay, maybe it's going to like hover around here for a little bit like SPY. And like it was just flat on rejection today. Like it wasn't even like, this is something you'd see on like a 5-minute chart, right? If you're like day trading something like this, if you look at that daily chart on the Qs, it's like rejected. It was bad.
It's so bad.
Disgusting chart.
I mean, I sent it to my subscribers this morning because like I haven't bought a stock in like over a week and a half. Even when we had this most recent rally, I wasn't bullish. You guys are aware of this. Like you guys were bulled up more than I was, and I felt like the Grinch. Last week's episode, I called it. I felt like the Grinch. I just didn't feel like the tariff uncertainty is still, I view the tariff uncertainty as an underappreciated risk that it's going to have a much greater impact on the economy than actual tariffs themselves. What do I mean by that? The real damage isn't just in the cost increases or on the importing goods. It's the hesitation that these tariff wars causes, the second guessing from C-suite. It's going to be a ripple effect across a lot of the corporate business development deals, corporate decision makings, that is going to stall growth and business spending in ways that aren't immediately quantifiable. Like you don't know what the impact's going to be. Like these companies truly do not know what their cost structures are going to be in 3 to 6 months from these tariff talks. They don't know how to absorb the risk and move forward. So that's going to cause them to delay hiring, put off a lot of these CapEx or AI-related investments. And also, if you're on the retail side, like they're going to reconsider the inventory levels because you just don't know. Like when consumers, I mentioned earlier on this call, like on the stream, like consumers, they see headlines. They're not dumb. They preemptively decide what to do based on what they read. So when they're going to adjust their spending patterns, when they read constantly tariff wars, raising costs on goods, like that's going to have a psychological effect of uncertainty that's going to stall momentum so much faster than the actual policy change. That's why like we see the market correcting 13-14% when the effect's going to happen April 2nd. Why is that? It's because the psychological effect already occurred. People are adjusting and the damage is done. So there was a game of I'll pass it to you, Sam.
I was going to say the market, the day that they announce that we're in a recession is probably going to be the day that the market bottoms. Only because of the fact that it usually is a self-fulfilling prophecy. And the market, of course, is forward-looking. And the market is ran off mostly by algorithms. But those algorithms are configured by humans. And the algorithms react to either price levels, headlines, whatever. And that's just what the market's going to do. It's always going to front run it. And it might be a self-fulfilling prophecy. But if things like start to sniff the other way around, it's going to go the other way around, and it'll probably bottom before we haven't made a new lower low, right? So we could be talking about something completely different next week. But when you do think of the impact of these tariffs, yeah, it's still not April 2nd, right? Like it's still March 20. It's still end of March. So we don't know if this is actually going to be in place. We're certainly getting more talk about tariffs now when people thought it was going to be over. And if you think about that sentiment, the market has been moving off of it. To me, I thought the market stopped caring about tariffs, right? Because we had more talk about it yesterday. And then all of a sudden today, there's more talk about it. It's like, oh, here we go again, that sort of thing. It's like, man, kind of makes me think like, dude, maybe I kind of miss Biden, right? I kind of miss my homie G Biden because he wouldn't
not if you're a Tesla shareholder.
Yeah, well, I mean, if you're a Tesla shareholder, you would be at the same place you were a few months ago, right? So, I mean, we'll see. Nothing would happen. You would have been the same place. Maybe the market would have been in the same place too. Who knows? If well, actually, no, that would have been Harris. Maybe a different story. Who knows? But I don't know, man. Market's very forward looking with it. And what do you think about crypto? Crypto really held up well.
Dude, crypto, that's why I don't think we're going to have that capitulation. I don't know. It's totally different industries, but it's still such a risk-on barometer, crypto, or Bitcoin specifically, that Bitcoin's holding up really well. You assume that the way the market's reacting past month, Bitcoin would be trying to fill that post-election gap fill at $70,000. They're not. They're not even close to that level. That's showing me that maybe it's not as bad as feared. Maybe there's equity. The equity market is just mispricing. Like I said, the psychological effects of this tariff wars that are going to be potentially short-lived. Nobody really knows. But if I saw crypto breaking down along the equity markets, I would actually be a lot more fearful. And I think there would be more capitulation in the market. I don't know. Logical. Do you think that the crypto holding on strong is somewhat of a Haas glass full with this pullback in the equity markets? Or do you think it's just a totally different entity? You should not correlate them at all.
I mean, sure, it's not a bad sign for risk on, but at the same time, dude, like how much market cap is in crypto markets? It's like not a lot. It's under 3 trillion. That's like one Apple. So I'd rather pay attention to equity markets. Like crypto could go to zero and it wouldn't matter because it doesn't really impact the overall global markets. So I mean, yeah, there's room for speculation, but if you really think about it, if you want real speculation, I bet you right now Bitcoin dominance is really high, which tells me that people are actually more risk off. What you really want to see for risk on is to see Bitcoin dominance come down. Altcoin volumes are up. I bet you all the altcoins are down like 70%. I haven't checked them lately.
Wait, you're saying that? Sorry to interrupt. You're saying that if Bitcoin is dominant, then it's risk off?
Yes.
Because
correct.
Bitcoin's is
Bitcoin dominance. So Bitcoin dominance is just basically you take the market cap of Bitcoin divided by the market cap of total crypto. And so if that's high, that typically means people are speculating less. So the people who are crypto investors are just sitting in Bitcoin right now. And I bet you, like, let's see, right? Like Bitcoin's holding up, but what's Solana at?
Yeah, you know what? Actually, no.
136. I mean, it's still down 60% from the highs, right? Like, I mean, let's be real. There's been a crypto bear market.
Yeah, no, there has.
Unless you held, and even if you held, and we're talking about crypto holding up, but dude, crypto was at like a what? Bitcoin was at 100K, 109K, right? That's where the high was. Dude, we're at like 85K. I mean, that's minus 20%. Basically went to a bear market just like the mags did. So, I mean, it's holding up, but like not really. And it's holding up so far. It's kind of holding up in line. And if Bitcoin is the mag 7 of crypto, then it's basically holding in line with equity markets. I would basically say it's a wash, and the high beta names have been destroyed in stocks and crypto alike. So I don't see much signal there. And, if markets go lower, Bitcoin goes lower. If markets go higher, Bitcoin goes higher. That's just kind of what it is. They're highly correlated. And I would just say it's been in line so far.
I mean, like crypto could just go down in an hour. It could just be down like 10K in an hour.
Yeah.
So like,
We could be at 82K in 2 seconds, and everyone will be like, "Oh my goodness!"
By the
it's a
next
meltdown.
segment, it's going to be down below 80K. Like
This
it could just
segment
easily happen
right now in the next 15 minutes. Yeah, exactly.
No, for sure.
Yeah, I mean, look, I just here's what I'll say. It's like the tariff stuff is tough because it brings uncertainty. I don't care enough about the tariffs if they end up, once we get clarity and it's like, oh, not a big deal. But right now there's still so much uncertainty. So I think in the meantime, you got to play a little bit, like be on your toes, and only if you care to manage money on a shorter-ish time frame, medium-ish time frame. If you're sitting in a long-term time frame and you're not DCAing every paycheck you get, why are you even doing this, right? Like, if you're just sitting in a retirement account, something you're not going to look at for 30 years, the best thing that can happen to you is the prices go down and you get to accumulate more numbers of shares. So, you should welcome a bear market realistic, but for me, I'm not doing that. So I'm really trying to optimize, year to year, what my returns are going to be. So I'm just managing it a lot tighter. And again, right now, I think that the risks are still down to the economy. Like, I was listening on a Spaces earlier today. There's a guy, he's really smart, and he's been bullish for the last 2-3 years. I mean, even in 2022, he was very bullish and very constructive on the U.S. economy. Today was the first time, I was just listening to him a couple hours ago, and today was the first time I heard him sound bearish. And he was like, which is crazy, because he was like, the auto tariffs basically mean unemployment ticks up in that sector. It just destroys it. And so, I mean, off the bat, and again, let's take one step back. What was the point of this whole tariff stuff, right? The whole point was the administration is focused on the 10-year. Administration is focused on bonds. And so maybe he felt like he was losing, grip of that situation because stocks start ripping again, 10 years back over 4.3.
Yeah.
Did he even do anything? Is he starting to look kind of like a clown, realistically, for what he just did? It was a total tantrum. He made no progress. And then what? So I think he has to kind of stick to this plan if he wants to really see rates come down. And the only way to see rates come down is inflation comes down, unemployment potentially ticks up. So, and slowing consumer spending slows, and consumer sentiment surveys were very low. Consumer confidence, lowest it's been in years. So he's doing what he's trying to do. And yeah, I mean, I think he's just kind of sticking to the plan, and it'll be good for us longer term, but he's definitely trying to cause pain in the near term. You could tell. So I'm just on edge. Like I said, willing to take it day by day, week to week, because I think in this kind of choppy market, you really have to. But I'm sticking to things that are not as exposed. Like the things that I'm not really exiting right now are Latin America. I think that economy is in a completely different state right now. I think that those assets are very cheap. And biotech and healthcare, which I've been pounding the table on because they don't have U.S. consumer exposure. And if rates come down, they should be a big beneficiary. Everything else that's tech and consumer related, it's kind of like, I want to get aggressive if I feel that we're going to head back to the upside, but you really do need confirmation that this was just kind of, okay, downside is over. But because the thing is, let me explain how the math works, and people struggle with this. I don't think we're going to have a 2022 situation, right? But if you did, this is how the math works. If you see a stock that's down 50% and the max drawdown in hindsight ends up being 70%, and if you bought that stock down 50%, you will be down 40% at some point, and that hurts. So I think it's okay maybe to wait for some of this dust to settle and then get a little bit more aggressive to the upside. And if you have to buy 10-15% higher, it's a lot better than being the alternative, which is being down up to 40%. I'm not calling for 70% drawdowns because I don't think we're at a similar place as we were coming out of 2021, coming into 2022. It's very important. Like, people are sitting here, being super bearish. I don't want to be super bearish. We've already discounted a lot of downside. We've already taken out a lot of the froth of these high beta names. Mags are in 20% drawdown. Like, we've already taken out a lot, right? And when you were in 2021 going to 2022, you had 0% interest rates about to head into the fastest rate tightening cycle ever. you're about to get into QT, and you had, SPACs going public, money flowing. DCF models were basically broken when the discount rate's at zero. And yeah, I mean, everything was broken. So you can't really compare where we are today versus where we were in 21 headed into 22. And also we had inflation about to go to 9%. I mean, we're at 3% inflation. We're at 4.25 on rates, Fed fund rate. That can come lower. Inflation can come lower because if spending slows down, unemployment ticks up. I mean, we are just in a very different situation. I think everyone, I don't know what it is. There's this like fixation with just being uber bullish or uber bearish. Why can't you just kind of be like in the middle and be sensible and just take it as it comes, and then like change your opinions based on the facts changing and the price action? And it's okay to be cautious and still bullish and optimistic, which I am. I would put myself in the camp of I'm still cautious but bullish, optimistic, constructive, etc. That's what I would say where I'm at right now.
I mean, I think like you said, you can't be type A. You can't be in one category. I'm not a permanent bull, but like I am a pretty big long-term bull. I think we're fully in the fourth industrial revolution, but you can't be blinded by today's reality. Like you can be future looking, but also be present in today's reality. What's happening? I have not been aggressive in 2025. I learned my lesson in 2022. My chest is hairier. I have gray hair on my sides. I can't afford another 2022. Physically, emotionally, financially. I refuse. I'd rather be late, miss a couple percentages, and catch a real run. So what I mean by that is we have downward sloping moving averages. That hasn't happened since 2022. And that lasted one full year before they adjusted going back up. So if you just waited for the downward slopes to move back up, you missed a 4 to 5% move. But guess what? The QQQ went from 270 to 500 after the slopes moved back up. Who cares about the first couple percentages? So like patience is the name of the game this year. You have to be patient. And I have a 10% cash position. I haven't added for a week and a half. Even when we were at oversold nature in the daily and weekly charts, there were no deals for my high conviction names. It was still like, okay, I can slowly build it, but I'm not using all my cash. Like it wasn't like we got Cloudflare at $80, Palantir retesting 50, CrowdStrike under $300, Axon didn't even break under $500. Like these are names like I want to keep building positions on, but they were running so hard that even a 25-30% pullback, it wasn't a great deal. So I think this move right here is the best case scenario for long-term traders and investors, where it got rejected in the 200-day moving average. Clearly, it feels like we're going to get a next leg down. I think this bounce trapped a lot of investors, and now it's going to cause that where I'm really offsides, and now the capitulation might occur, and that's when the prolonged selling and pain can happen. We didn't experience pain this past month. There was no pain. It was uncomfortable, no pain.
I don't know, Sam, if you wanted to say something, but I wanted to kind of pivot, but like still on this, but like a little bit more specific on the risks of this market.
Well, I mean, I was just going to say that.
But before I do that, wait, I can't hear Sam.
I can hear him.
Okay, go ahead.
Okay. I was going to say that, we've had a few things happen on the indices, like Shao was saying, that hasn't happened in a long time. The 200-day moving average is probably the biggest one. But we've had a lot of crossover let's see here. We've had a lot of crossover for some major moving averages let's see here. All right. So we had a crossover of the 20-day and the 200-day. And for me, my thing is going to be when it comes to the 50-day crossing the 200-day. If that happens, everyone put the damn helmet on, because that was a signal in 2022. Now, I'm not going to go ahead and forecast, be like, I'm going to all cash if that happens. Shai's right. I mean, even though we've priced in a lot already on the downside, a lot of algos trade and a lot of hedge funds trade on these moving averages. Under the 200-day moving average, this is not a pretty sight, right? Like, just look at this freaking chart. Like, this is ridiculous. But if that 50-day crosses that 200-day, it's very likely that we could be in for some long-term pain unless we just bounce back really quickly. But at the end of the day, I'm the same thing with Shy as well. I'll just keep investing, mostly because I can't time it, and I'd rather not. I feel like that'll be more mental capital on my end in order to time that. But yeah, at the same time, being realistic, coming into this year, it was the same thing with me where I didn't want to. 2023 and 2024 were really good years, right? A lot of that for me was attributed to using leverage. And coming to this year, I've drastically reduced the amount of leverage that I'm using. And don't get me wrong, like February was like, oh man, maybe I made a mistake. But now, this is the thing when it comes to timing the market is that I won't know when that time is to start pressing the gas. But like you guys, probably not the best environment to do it right now, especially since we are in a downtrend and we just kind of rejected the possibility of going back in that uptrend. So it's very tough to even see the big picture here. Like there's no ChatGPT 5 that's coming out right now. And even if it does, well, we already had that big moment. There's no innovation, massive catalyst that's happening today. But I will tell you something. We are in a rate cut cycle. So one thing that I don't do is fight the Fed. Like I do not fight the Fed. There is not one single possibility priced into the market or even coming out of Jerome Powell's mouth, even from the FOMC meeting minutes, that they will hike rates. Other than maybe some hawks talking about that on TV or whatever, because that's just what they love to do. But at the same time, when they start talking about hiking rates, that's when I might be like, oh, okay. I might change things a little bit because that will be a massive pivot. But until they have that massive pivot, or until like they're not going to have a massive pivot, that'll just make them lose credibility. But I do not want to fight the Fed. I don't want to fight the Fed. What were you going to say?
I think there's zero chance the Fed are going to rate. There's zero chance the Fed are going to raise heights. That would be the biggest FU middle finger to Trump, who's doing all these things, all of these like moves to essentially force rates lower. It's not working. So now like he did all this destruction for no reason, to be honest, because it's just not working. But that would be wild. I would be scared. No, this might turn to 2022 if rates got higher. Got increased.
Realistically, we're about, let's wait to see what the March CPI report is, because I think inflation is headed lower. And ultimately, you're not going to get inflation ticking up when you have potential unemployment ticking up. You have fiscal deficit spending coming down. So if those things do materialize, then I just don't see a world where inflation comes up, which is the reason why they would hike rates. So we'll have to keep an eye on inflation, but I think we're going to get a pretty chill, cool print on in March or in April for March report, and we'll have to see. Hopefully it's not too cold. I want to jump into the next thing I want to talk about, but before I do so, I want to shout out our sponsor, ValueSense. The landscape of investment research is undergoing a massive shift. Sentiment tracking, automated valuation models, and real-time fundamental analysis are no longer the domain of hedge funds alone. ValueSense is breaking down these walls, ensuring that sophisticated data-driven strategies are no longer monopolized by the financial elite. If you are interested in getting a leg up on the competition, check out ValueSense at valuesense.io. Alrighty, so I wanted to talk about something that I thought was a pretty big piece of news, and something that I've been warning about since we started this pod about 2 months ago now. And it is the real risk in this market. And I know we've all kind of talked about it, and I know Shai's acknowledged it, and we all kind of have, but it's the end of the hardware phase one of AI. And it's the truth. And because, look, when DeepSeek came out, and I want to cover a couple of facts and then take us to what the news was today. When DeepSeek came out, whether they were lying or not about the amount of money and the efficiency, blah, 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 about their DeepSeek model that came out, like the point of the matter was people are going to start questioning, is all of this spend necessary? And more of that commentary has been coming out lately. And, we had all of the hyperscalers come out and say, oh, we're going to do 100 billion, 90 billion, 80 billion. It's insane numbers that they're throwing around there. And guess what? None of the data center stocks saw any life. They actually went lower than the DeepSeek moment. And in my view, that is telling you that they began quantifying the amount. So it's no longer up to the imagination. Multiples don't run to the skies anymore. There's like real things we can start modeling. Okay, the growth of CapEx is going to decelerate into 2026. Now we know, okay, what should we expect for revenue for all these companies? So we knew that quantifying this thing is the beginning of the end. And DeepSeek was the beginning of that as well. And that's kind of been the trend. And so I see all over Twitter, NVIDIA is the cheapest it's ever been. And how many times on Spaces in the last year did we hear people say AI is secular this time and chips might be secular this time? And I kept saying anytime somebody tells me that a cyclical industry is secular, immediately like red flags are up. So I was just never convinced of that. Look, it is a secular trend, but there's going to be cyclicality within it. That means that there's booms and busts in these cycles. It's called the bullwhip effect. You order too many, you have to resize back to whatever. And so here's the problem with all of the hyperscalers giving out their biggest possible number and why it didn't impact positively all these data center names. Because there's two things here. One, they gave the biggest possible number. It's not going up from there. If anything, the risk is to the downside of those numbers if the market doesn't believe them. And what did we get today on the news? So today we saw Microsoft cancels or postpones 2 gigawatts of data center projects amid AI infrastructure oversupply concerns. Whatever, AI market shift leads, whatever, you get the point. They're scaling back their spend in AI, data centers, and CapEx. And the reason why that's so important is because they're the first to reduce their spend. That means that the other hyperscalers can now potentially take a step back and say, look, they're kind of lowering their guns. Now we can kind of come to a point where, hey guys, can we stop spending $100 billion each a year? Especially when you have Amazon, Microsoft losing their 200-day moving averages. These are stocks that are already in bear markets right now. Mags hit a bear market. It's not healthy. I mean, you're talking about death cross, which is the 50 crosses the 200-day to the downside, Sam. Microsoft has had their death cross in for a long time. I mean, that stock chart is one of the worst in the market. It's a heavy stock. It's a $3 trillion company. There's not enough liquidity to support that. So if you're a shareholder of Microsoft and you own a lot of that thing, I kept saying the big risk here is, look, dude, your stock is tanking. And if you don't do something to save it, it's going to get a lot uglier from here. And so we understand that there's risks on the top line revenue growth long term. But if you're not able to show ROI for this insane amount of CapEx that you're spending, then what are we doing this for? We need to show EPS growth. That's like at a minimum, you got to protect your stock. So that's the problem with NVIDIA and all of the other data center names is they're at the whims. It's like one person's costs is another person's revenues. And at this point, the person spending is, the one who's losing. And so they can just cut back that spend and start winning again. So if you want to save, you might have to cut off NVIDIA to save Microsoft. And that's just what they're doing. And we saw that in the year of efficiency in 2022 when Metaverse started pulling back their spend in the Metaverse. Meta started pulling back their spend in Metaverse. And so that's what I think is going to happen now. And so if I was in these data center names, if I was in these, cyclical names, hardware side, data center build outs, a lot of these chip names, I'd be very scared. Full disclosure, I shorted SMH today. I think it looks like I saw a.
Let's see if you're still shorting that when
is where the risk is in this market because, like the mags, they can cut down their capex spend. I mean, that's a good point. Like, I could change my mind tomorrow, but I will say it looks really heavy. If you compare the charts to if you compare SMH, it looks like it's in a stage 4 drawdown, which is like a very common phrase for traders. Like, look at ARC in 21, look at Cisco in 2000. It's mirroring those things, and they just had a death cross on the daily chart. So it just doesn't look good. It looks heavy, and they're cyclical. So it just feels like an easy component to short. Yeah.
So I do agree with, I think I'm going to rebuttal some stuff. I agree that the data center play is not where you want to be, is not, the IT budget's evolving. Just say that. Regarding Microsoft, I've been bearish on Microsoft since last summer. The dumbest valuation, it's insensual with OpenAI. It's short-lived. The Azure numbers, it's not, we got no clarity on really what's the Azure growth and what's kind of manipulated a bit. But for today's news story on the ending the leases, I had a different take. And I think it's more because after NVIDIA's GTC event, when they released the NVIDIA's Rubin architecture, the next latest and greatest in 2027, it showed that, Sam, I don't know if you remember what the number was, but it's 70 or 600 GPU rack consuming over 600 kilowatts of power.
Yeah.
It's something absurd that is going to, it's not just a casual innovation upgrade. It's going to be a massive reset of how AI data centers need to be designed for. It's like, that's why I think Microsoft is pulling back, because after the GTC events, their data center expansion strategy isn't built for the kind of power density NVIDIA is now requiring in their latest and greatest. So I think it's less about Microsoft abandoning their AI investment. I think they're hitting pause to reassess how to scale efficiently without running into power and cooling bottlenecks. So I think, again, this goes back to my point where the IT budget's evolving. It's not just about buying more GPUs. It's now about deploying them without exceeding the power grids, the the physical space limitations of existing infrastructure. And this is going to the point that I want to call out is why I've been adding to Astera Labs like a lot in this pullback. Like, I think that the market is still missing the real breakout winner of the next.
No, I didn't mean to interrupt you. Go ahead. Continue.
No, I was just gonna say, like, I think the market is clearly still missing the next breakout like winners of the hardware trade. Like, it's evolving, and the next cycle of the hardware component is going to be all about not the companies enabling AI hardware. It's going to be which companies allow AI hardware to scale. The biggest challenge today in AI isn't just about the GPUs or training data. Like DeepSeek Playbook Reveal emphasize that. It's now all about the next big phase is going to be about how fast can data move from between the GPUs, the memory, the storage. Like, AI models are now becoming more and more advanced. They're going to demand more and more bandwidth. And because inference is no longer just happening in these centralized cloud clusters, it's moving to the edge devices, Cloudflare. It's co-processors, and it's also these like memory fabrics that are going to be so vital. And that's exactly why Astera Labs connectivity layer is going to enable these AI workloads to finally operate in real time and make data so fast from one another that it's going to take over as demand starts to explode. So I think data center, like, I think HPE, I think Dell, SMCI, that's dead. Why would you be in those names?
If you look at
I think
those charts are terrible.
One trick pony data. Yeah, it's awful. Like, these one trick data center ponies, why be in them? But I think that there's an evolution that's happening right now in the data centers spend. I don't know, Sam, what do you think about that? Because I threw a lot out there, and I feel like you might be in the middle between logical and myself.
No. Okay, when DeepSeek came out, it took me a little bit of time to understand this, and I've talked about it many times at length, is that, like you said, it's no longer about who has the biggest, baddest GPUs on the planet in size, right? Like, of course, you want to have the best of the best available in your data centers, especially with the hyperscalers. But the bottleneck is not the compute anymore. It's a network bandwidth. And I agree with you with the Astera Labs. Like, I haven't added yet, but I do plan to at some point. But at the same time, like, when I think about Astera Labs, I'm bullish in their future because they're more like their specialty with their Scorpio product is really just about boosting the efficiency of the Ethernet signal using their I forget the exact name of the devices, but using those when the Ethernet plugs into the cluster. So that is going to help as far as the network bandwidth, and that's what DeepSeek did, is that you could do more with less. Okay, that's where the efficiency comes from, being able to use only 5% of the queries versus the whole 100%, and also being able to point your software and the code to use your models more efficiently by using all the layers of compute versus selective ones and so on. Like, I don't want to get too specific when it comes to that, but I think that's where the bottleneck is today, because everyone has been focused on. I'm not going to say AMD is a great company, but like, I'm not trying to buy AMD right now. First of all, if I'm going to buy into a secular trend, I'm going to buy the leader usually, especially when it's pulled back quite a bit. But I'm not a buyer of NVIDIA right now. I can't buy NVIDIA right now because I think there are other better plays on the horizon besides NVIDIA. But I also think that I need to have something in my portfolio. If I'm going to add into something, I need to have something that's going to be a beneficiary of the application of AI versus just providing the compute, which is where everyone has been. I do have some data center positions in my portfolio, but they're not nearly as big and concentrated as my software positions. And I mean, for me, that's kind of my specialty when that's my wheelhouse whenever it comes to when I invest in, what I do research, and it's what I find the most fascinating is the software application. And I'm not going to sit there and be like, I hope it's software's time. I hope it's software time, because then that would put me in a place where maybe I've been hoping for the last 2 years, but it's like software has been performing terribly, but not nearly as good as the data center stuff. So if you look at SMH, which is the semiconductor ETF, mostly NVIDIA and Broadcom, versus IGV, which is a software ETF, lately, for quite some time, and I've been talking about this ratio for a while, is that the IGV SMH ratio has been outperforming, which means that IGV has been outperforming semiconductors for quite some time. And I've noticed this for quite some time, and it's helped me build that conviction. Like if I'm going to stay invested in the market and I'm going to land myself in companies that I really do believe in, that'll still continue with this AI tailwind, which I don't think it's ended, I want to be mostly in software or something more in the application layer. That also includes ad tech as well. But if you think about the players that might benefit the most off of this, it's probably going to be the unloved names that are mostly focused on the software. And one of them may or may not be a position in my portfolio, Snowflake. And I think that you're in agreement with me on that. I think logical. I think you might be in agreement with that, but not necessarily in the portfolio positioning way. But I think we all are kind of in agreement that the software layer is going to have its profound effect probably this year. If not, it's already happening. The rotation is probably already happening, considering that the ratio is performing well.
So I think it would have happened this year if it wasn't for these tariff wars. I think the psychological effect for a lot of these corporate business development deals have gone kicked back a couple quarters maybe. Like I thought the summer, not the summer, the second half of this year would be the firework year of software. Like the baton has been officially passed down. I just don't think that's the case anymore with this tariff war that we're in. I think a lot of people they don't know the risk parameters of their investments, like dollars spent, working capital. They're going to be in pause mode. I think that's going to affect the software names of the consumption model. I think they're going to be still strong. I think they're not going to be aggressive on the guide up because of everything I just called out. And I think they're not going to have that massive reacceleration that I thought they would because of the anchor on those everything that's happened geopolitically. But I'm telling you guys, it's not if, it's when. It's going to happen. It's going to happen. Nobody knows when. Again, timing. I am so bad at timing. People think I'm a genius in timing because I got Palantir under 10, Rock Club in 5. Like, no. I could care less on when I'm going to add the names. I have a DCA plan, and eventually, in long run, it's going to hopefully catch up to my thesis, but I can't time a market. I can't time a stock. I am not good at that. I'm not logical. Logical is great. He's a 9 EMA on the 5-minute chart. I am the 200-day moving average. SMA, not even EMA. SMA. I am just like very methodical, like very long-term, and I think what Sam's saying is very real. So I know we're at the top of the hour. We're going to wrap up here. I think we talked a lot of good stuff, interesting stuff. Like I did love the AI spending for hardware. The Tesla angle was really interesting. I think that this is the third straight episode where the market has just been correcting aggressively. It's a new game. It's a new era. 2025 is clearly not 2023 or 2024.
Yeah. This is our third or fourth week of like just having a blast with this new hobby. I mean, it's just really taking off. Losing money is just. It's been an amazing hobby lately.
Yeah, I wish they taught you how fun losing money could be. Yeah, I might go to a casino now because I'm having so much fun. I'm just gonna put it all in red.
Well, you might win if you do that.
Anyway, any closing? I'll give it back to them. Yeah, any closing words? Logical, Sam?
Yeah, I'll just say, obviously we didn't dive too deep into micro this time, like looking at specific names, but I think while there's a lot of volatility and there's a lot of stuff going on, it's important because it's kind of feeding the bigger picture. And, you know, you guys talk about software and all that, and I agree with you guys. Generally speaking, it is going to be that next wave of what's going to work. But when the market is not cooperating, when the backdrop is bad and there's uncertainty, nothing's going to work. And so we just need to see some of that resolve, and then we can kind of see on the other side of this. I think that those are going to be great winners. And so I'm just trying to be a little bit patient, and I do understand that some of those secular themes are great to be positioned in, and if you don't care for the near term what's going to happen, you can stomach the volatility, it's probably going to look great to be DCAing here. But again, just depends on who you are as a person. So look in the mirror and ask yourself that, and you can live with whatever decisions you make, and that's it. And yeah, I mean, again, it'll do good, but you got to just be okay with whatever the outcome is, given all the uncertainty right now. And I'm kind of okay that our shows lately have been kind of diving deeper into what's been going on, because I know that there's a lot of anxiety and uncertainty in investors too, not just what's going on in the economy and all that stuff. So
Yeah, I agree. I mean,
Yeah, well put.
I think that you gotta figure out what type of investor you are, and a lot of that is distributed to your risk tolerance. I mean, everything really always comes down to risk management. You need to assess how much risk you are willing to take on, and if you can't take on risk, because risk always seems like it's a great thing to exercise when the market's going up for 2 years. When something like this happens, same thing happened in fall. I wouldn't really say August 5th was the same thing, because that one was more of a, I want to say black swan, but definitely got resolved overnight. When something like that happens, it kind of teaches you a little bit of a lesson and you learn from it. I mean, I don't think anyone's really going to know exactly how to cruise this ship from the get-go. Everyone's going to make mistakes. The greatest traders and investors in the world make mistakes all the time. So, I mean, that's just how it is. Like, you're going to make mistakes along the way, and you just have to learn from it. And if you don't learn from it, then you're going to blow up.
Yeah. Well put. So again, thanks for tuning in, guys. Strange Things, episode 11. Yeah, tune in next time, and hopefully we're both a 200-day moving average, or maybe we capitulated. Either way, I want some direction. Next leg. Give me some action.
Let's go.
Thanks,
seriously,
everyone.
well said.